Something's breaking in the financial system right now, and most people have no idea it's happening. For months, bond market dealers, the institutions that keep global finance running, have been quietly showing signs of stress. Now, that stress just turned into something far more serious. Bid-ask spreads, the hidden tax you pay every time bonds change hands, just blew past levels we haven't seen since the chaos of 2020. This isn't just technical jargon. When the machinery that keeps trillions of dollars moving starts to malfunction, everyone feels it eventually, in their retirement accounts, in the stability of their pensions, in the basic functioning of credit markets that determine everything from mortgage rates to corporate borrowing. The question isn't whether this matters, it's whether we're watching the early stages of something much bigger. Here's what we're going to walk through together. First, I'll explain what's actually happening with these dealer spreads in plain English, no finance degree required. Then we'll dig into why this matters so much, especially if you're in or near retirement. We'll look at what caused this pressure to build up over the past year, examine the specific warning signals flashing right now, and talk about what this could mean for your financial future. By the end, you'll understand something that most financial news completely misses: how the plumbing of the financial system works and what it means when that plumbing starts to crack. And if you want to stay ahead of these kinds of market developments before they hit mainstream news, make sure you're following what happened after. We break down complex financial events into clear, actionable insights. Let's start with the basics. Imagine you want to sell your house. You could try to find a buyer yourself, but that takes time. You'd need to advertise, field calls, arrange viewings, negotiate. It's exhausting, so instead you work with a real estate agent who has buyers ready and can make the transaction happen quickly. Bond dealers work the same way, except instead of houses, they're trading trillions of dollars in government bonds, corporate debt, and other fixed income securities every single day. Here's the thing most people don't realize. When you buy or sell a bond, whether it's in your 401k, your pension fund, or a treasury bond you purchase directly, there's almost always a dealer in the middle. They're not doing this out of kindness. They make money on something called the bid-ask spread. The bid-ask spread is simple. It's the difference between what a dealer will pay you for a bond and what they'll sell that same bond for to someone else. If they'll buy your bond for $99 and sell it to the next person for $100, that $1 difference is the spread. It's their profit for providing immediate liquidity, for being ready to trade right now instead of making you wait to find a buyer yourself. Under normal conditions, these spreads are tiny. We're talking fractions of a percentage point. The market is so deep and liquid that dealers compete aggressively, and that competition keeps spreads narrow. It's like a well-oiled machine humming along. But here's where it gets critical. When spreads suddenly widen, it means dealers are demanding more compensation for the risk they're taking. And when spreads blow out past historical norms, it means dealers are genuinely scared. They're either pulling back from the market, demanding much higher premiums to participate, or both. That's exactly what's happening right now. And it's happening in the most important bond market in the world, U.S. Treasuries, the bedrock of global finance. If you're in your 60s, 70s, or 80s, you might be thinking, I don't trade bonds. Why should I care about dealer spreads? Here's why this hits close to home. First, bond market stress directly affects the value of fixed income investments in your portfolio. Most retirement portfolios include significant bond allocations, government bonds, corporate bonds, bond funds. When dealer spreads widen dramatically, it means the bonds you own become harder to sell at fair prices. If you suddenly needed to liquidate part of your portfolio, you'd face much wider spreads, effectively paying a much higher hidden fee just to access your own money. Second, this kind of dealer stress tends to spread. We've seen this pattern before. It starts in one corner of the bond market, then ripples outward. Corporate bonds become harder to trade. Municipal bonds, the ones funding local governments and providing tax-free income for many retirees, start showing stress. Even mortgage-backed securities, which directly influence the rates on home loans, feel the pressure. Third, and perhaps most concerning, when the Treasury market shows this kind of dysfunction, it affects everything else. Treasury yields are the benchmark for all other interest rates in the economy. They influence what banks pay on savings accounts, what you can earn on certificates of deposit, what pension funds can realistically expect as returns. If the Treasury market isn't functioning smoothly, none of these other markets can function properly either. For retirees living on fixed incomes, market dysfunction isn't an abstract concept. It's the difference between stable income streams and sudden volatility. It's the difference between being able to plan your finances with confidence and facing unexpected disruptions. And right now, the signals suggest we're moving toward disruption. To understand why we're at this critical point, we need to look at what's been building over the past 18 months. It starts with the Federal Reserve. After years of keeping interest rates near zero and buying massive quantities of bonds to support the economy during the pandemic, the Fed executed one of the fastest rate hiking cycles in history. They took rates from essentially zero to over 5% in less than a year and a half. Every time the Fed raises rates, bond prices fall. That's just how bonds work. Existing bonds paying lower interest become less valuable when new bonds pay higher interest. So dealers holding inventories of bonds were suddenly sitting on assets that were declining in value month after month. But there's more. At the same time the Fed was raising rates, they were also shrinking their balance sheet through a process called quantitative tightening. For years, the Fed had been a massive buyer of Treasury bonds and mortgage-backed securities, effectively acting as a dealer of last resort. When they started pulling back, it meant less support for the market, more bonds that private dealers needed to absorb. Now add regulatory changes that happened after the 2008 financial crisis. New rules limited how much capital banks could commit to their trading desks. These rules were designed to make banks safer, and they probably did. But they also meant that dealers couldn't hold as much inventory or take as much risk as they used to. When market stress appears, they have less capacity to smooth things out. Throughout 2023 and into early 2024, dealers were managing this tension. Spreads widened somewhat, but stayed within acceptable ranges. They were essentially saying,
"We'll still make markets, but we need to be compensated more for the increased risk and lower capacity we're operating with."
Then came the additional pressures. Concerns about the federal deficit and whether the government would need to issue even more debt. Geopolitical tensions that made global investors nervous. Uncertainty about whether the Fed would actually cut rates or keep them high for longer. Each of these factors added another layer of stress. Think of it like a bridge designed to handle a certain amount of traffic. For months, the traffic has been increasing. Heavier vehicles, more frequent use, some maintenance getting deferred. The bridge is still standing, but the engineers are starting to notice stress fractures.
What we're seeing now is those stress fractures turning into something more serious. Let's talk about the specific signals that have market insiders worried.
The most obvious is the spreads themselves. In normal times, you can buy or sell a Treasury bond with a spread of just a few basis points, maybe 2 or 3/100ths of a percentage point. Recently, spreads in certain parts of the Treasury market have blown out to 10, 15, even 20 basis points. That might sound small, but it represents a 5 to 10 times increase from normal levels. And it's not just the size of the spreads, it's the consistency. Wide spreads that appear briefly and then disappear can happen for all sorts of innocuous reasons. Maybe there's a temporary mismatch between buyers and sellers. Maybe it's the end of the quarter and dealers are managing their balance sheets. Those are normal. What we're seeing now is persistently elevated spreads across multiple parts of the Treasury market. It's showing up in the futures markets, in the cash markets for actual bonds, in the repo markets where dealers finance their inventories. When the stress is that widespread and that persistent, it's telling you something fundamental has changed. Another critical signal is dealer positioning. Data from the Federal Reserve shows that primary dealers, the big banks authorized to trade directly with the Fed, have been reducing their Treasury holdings significantly. They're essentially stepping back from the market, holding less inventory, making fewer commitments to provide liquidity. This is rational from their perspective. If they're worried about further losses, or can't commit enough capital to make market making profitable at normal spread levels, pulling back makes sense. But when all the dealers pull back simultaneously, you get a liquidity crisis. We're also seeing unusual patterns in trading volumes. In a healthy market, volume tends to be relatively consistent, with normal fluctuations around economic data releases or Fed announcements. But recently, we've seen days where volume drops dramatically, a sign that market participants are simply choosing not to trade rather than deal with the poor conditions. And then there are the more subtle indicators that professional traders watch. The relationship between different Treasury maturities has become distorted. Normally, longer-term bonds move in relatively predictable patterns compared to shorter-term bonds. When those relationships break down, it's often because dealers can't arbitrage away the differences. They don't have the capital or the appetite to take on the risk. One more signal worth mentioning. Corporate bond spreads are starting to widen in sympathy. When companies issue bonds, they pay a premium over Treasury rates. That premium reflects the extra risk of lending to a corporation instead of the U.S. government. Recently, those premiums have been increasing, not because companies are fundamentally riskier, but because the entire fixed income market is under stress. If you're following what happened after, you know we've been tracking these signals for months, watching as each piece fell into place. This is why staying informed about financial market developments matters. You can see these things coming before they become front-page news. None of this is entirely unprecedented. We've seen dealer stress before, and understanding those past episodes helps us gauge how serious the current situation might be. The most recent comparison is March 2020, the early days of the pandemic. When COVID-19 hit and markets went into freefall, Treasury spreads exploded. Even though everyone wanted to own the safest assets in the world, U.S. government bonds, the market mechanics broke down. Dealers couldn't handle the massive volumes and wild price swings. Spreads widened dramatically, and the Treasury market, which is supposed to be the deepest and most liquid in the world, nearly seized up. The Fed had to intervene with unprecedented force, buying hundreds of billions of dollars of treasuries to restore order. It worked, but it was terrifying while it was happening. Go back further to 2008, the financial crisis. Dealer stress then was even more severe, but it manifested differently because the crisis started in mortgage markets and spread outward. Still, there were moments when even Treasury spreads widened dramatically as dealers faced capital constraints and pulled back. In 1998, when the hedge fund long-term capital management collapsed, we saw similar dynamics. Dealers who had been making markets suddenly found themselves overexposed and pulled back sharply. The Fed had to orchestrate a private sector bailout to prevent a systemic crisis. The current situation isn't as acute as March 2020 or September 2008, at least not yet. But the underlying dynamics are troublingly similar. Dealers under pressure, markets functioning poorly, liquidity evaporating in ways that can create self-reinforcing panic. Here's what makes the current episode different and potentially more concerning. It's happening without an obvious external shock. In 2020, we had a global pandemic. In 2008, we had a housing collapse. In 1998, we had a major hedge fund blowing up. Right now, the stress is building because of structural issues, the Fed's policy stance, dealer capacity constraints, the sheer volume of government debt that needs to be absorbed by the market. These aren't problems that appear suddenly and then disappear. They're persistent pressures that can build over time and then snap. So where does this go from here? Let's walk through the realistic scenarios, from best case to more concerning. The optimistic scenario is that the Fed recognizes the stress in the Treasury market and adjusts policy accordingly. Maybe they pause or even reverse their quantitative tightening program, providing more support to the bond market. Maybe they cut interest rates sooner than expected, reducing the pressure on bond prices and making it more attractive for dealers to hold inventory. If that happens, spreads could gradually narrow back to more normal levels. Dealers would regain confidence, markets would stabilize, and this entire episode becomes a minor blip that most people never even noticed. The middle scenario is continued elevated stress without a full crisis. Spreads stay wider than normal for an extended period. Trading becomes more expensive and less efficient. Investors face higher costs and more volatility, but the system doesn't break. It's like driving on a bad road, uncomfortable and slow, but you get where you're going eventually. This would mean persistently higher transaction costs for anyone buying or selling bonds. For retirees managing portfolios, it means paying more every time you rebalance or need to access funds. For pension funds and insurance companies, it means lower returns as trading costs eat into performance. Not catastrophic, but definitely painful. Then there's the more concerning scenario, a liquidity event that forces intervention. If spreads continue widening and dealers pull back further, we could reach a point where the Treasury market simply isn't functioning properly. Buyers and sellers can't find each other at reasonable prices. Volatility spikes. Panic begins to feed on itself. In that scenario, the Fed would almost certainly have to step in, just as they did in March 2020. They'd likely restart large-scale bond purchases, effectively becoming the dealer of last resort. They might provide emergency financing to primary dealers to support their market-making activities. They'd do whatever it takes to restore order. The problem with that scenario isn't just the market disruption itself, it's what it means for the Fed's broader policy goals. If the Fed has to restart bond purchases to support market function, they're effectively easing monetary policy at a time when inflation may still be a concern. It puts them in an incredibly difficult position, choosing between financial stability and price stability. And there's one more scenario worth considering, though it's less likely. Contagion that spreads beyond bond markets. If Treasury market dysfunction persists, it could affect equity markets, credit markets, even currency markets. We could see a broader flight to safety that paradoxically makes the safest assets harder to trade. Let's bring this back to practical implications. If you're managing retirement savings or living on investment income, what should you actually do with this information? First, understand that diversification matters more than ever. If your portfolio is heavily weighted toward bonds because you're conservative or in retirement, that's not necessarily wrong, but you need to be aware that bond markets may become more volatile and less liquid than you're used to. Having some portion of your portfolio in more liquid assets, money market funds, short-term treasury bills, even cash, gives you flexibility if you need to access funds during a period of market stress. Second, be cautious about making major portfolio changes right when markets are stressed. When spreads are wide and liquidity is poor, the cost of trading goes up significantly. If you don't absolutely need to sell, waiting for conditions to improve can save you substantial money. This is where having adequate emergency reserves becomes crucial. It means you're not forced to sell at the worst possible time. Third, pay attention to the types of bonds you own. Not all bonds are created equal when it comes to liquidity. Large, recently issued Treasury bonds tend to trade much more actively than older, smaller issues. Corporate bonds from major companies with lots of outstanding debt trade better than bonds from smaller issuers. If you're going to hold bonds, favoring more liquid issues gives you more options if you need to sell. Fourth, consider the role of bond funds versus individual bonds. This is a nuanced discussion, but in periods of market stress, bond funds can face pressure because they have to provide daily liquidity to investors even if the underlying bonds are hard to sell. On the other hand, individual bonds held to maturity aren't affected by day-to-day market prices. There are trade-offs either way, but understanding them matters. Fifth, stay informed. This is exactly why channels like What Happened After exist, to help you understand market developments before they become crises. When you know what to watch for, you can make better decisions and avoid panic. And here's something that doesn't get said enough. It's okay to be conservative right now. If the situation makes you nervous, if you don't fully understand all the implications, there's nothing wrong with holding more cash or near-cash investments than you might in normal times. The cost of missing out on some potential gains is often far lower than the cost of being caught in a crisis without liquidity.
Beyond your personal portfolio, this Treasury market stress has implications for the entire economy.
and those implications could eventually affect everyone.
When the Treasury market functions poorly, borrowing costs throughout the economy become less predictable and generally higher. Companies planning to issue bonds to fund expansion face more expensive and more volatile funding conditions. That can slow business investment and hiring. State and local governments that issue municipal bonds to fund infrastructure projects face similar challenges. If the broader bond market is stressed, municipal bonds become harder and more expensive to issue. That means fewer roads get repaired, fewer schools get built, fewer public services get funded. For the housing market, stress in the Treasury market eventually feeds through to mortgage rates. Mortgage-backed securities are priced relative to Treasuries, and when Treasury market function deteriorates, mortgage markets feel it too. That can mean higher and more volatile mortgage rates, making housing less affordable. There's also a global dimension. The U.S. Treasury market isn't just important for Americans, it's the foundation of global finance. Foreign governments hold trillions of dollars in U.S. Treasuries as reserves. Foreign corporations and banks use Treasuries as collateral and safe assets. When the Treasury market shows stress, it creates ripples across global financial markets. Central banks around the world watch Treasury market function closely because problems there can quickly become problems everywhere. If dealers are pulling back from U.S. Treasuries, they're likely pulling back from other markets too, tightening global financial conditions. And then there's the political dimension. The Treasury market's ability to absorb massive amounts of new government debt has allowed the federal government to run large deficits without facing immediate funding crises. If that absorption capacity diminishes, if dealers and investors become less willing to hold unlimited amounts of Treasury debt at reasonable prices, it puts pressure on fiscal policy.
Politicians might finally have to confront tough questions about spending and taxation that they've been able to avoid.
None of this happens overnight, but it's all connected. The stress we're seeing in dealer spreads isn't just a technical market issue. It's a signal about deeper structural challenges in how we fund government, finance the economy, and maintain global financial stability. As this situation develops, there are specific indicators worth monitoring. You don't need to become a bond market expert, but understanding what to watch can help you stay ahead of developments. First, watch the Fed's policy statements and actions. If they acknowledge Treasury market stress and adjust policy in response, whether by slowing quantitative tightening, cutting rates, or providing additional support to dealers, that's a significant signal. The Fed has tools to address this, but they have to choose to use them. Second, pay attention to volatility in Treasury markets. The MOVE Index, which measures expected volatility in Treasury bonds, is one indicator professionals watch. When it spikes and stays elevated, it means traders expect continued turbulence. Third, watch credit spreads in corporate bonds. If the stress in Treasuries starts pushing corporate bond spreads significantly wider, it suggests the problem is spreading beyond government debt. Investment-grade corporate bonds and high-yield bonds provide early warning signals of broader credit market stress. Fourth, monitor the financial news for reports about dealer capacity and willingness to make markets. If you start seeing stories about major banks pulling back from market-making activities or expressing concerns about capital constraints, take it seriously. Fifth, keep an eye on your own portfolio performance, especially if you hold bond funds. Unexpectedly poor performance or unusual volatility in supposedly safe bond funds can be an early warning that market conditions are deteriorating. At What Happened After, we track all of these indicators and break down what they mean in real time. When conditions change, we explain the implications before mainstream media catches up. That's the kind of insight that helps you make better financial decisions. Here's what we know. The bond market dealers who keep trillions of dollars flowing through the global financial system are under genuine stress. Spreads have widened past key levels that historically signal serious problems. The pressures causing this stress, Fed policy, regulatory constraints, massive government debt issuance, aren't going away quickly. This isn't a reason to panic, but it's definitely a reason to pay attention. We're watching one of the most important markets in the world show signs of dysfunction. That dysfunction might resolve smoothly with Fed intervention and improved conditions, or it might get worse before it gets better. For anyone managing retirement savings or depending on investment income, the message is clear. Stay informed, maintain flexibility, don't make rash decisions, but don't ignore the warning signs either. The bond market doesn't make headlines the way stock market crashes do. It operates in the background, quietly supporting everything else. But when it breaks, everyone feels it. Your mortgage rate, your pension fund's returns, the stability of your bond portfolio, the safety of the financial system itself, all of it depends on bond markets functioning smoothly. Right now, they're not functioning smoothly. The dealers who make these markets possible are pulling back, demanding higher compensation, showing signs of real stress. This is the early warning signal, the endgame signal that something significant may be building. What happens next depends on how policymakers respond and whether market conditions improve. But one thing is certain: understanding these dynamics now, before they become a crisis, gives you a crucial advantage. That's what we do here at What Happened After. We help you understand the financial developments that matter before everyone else is talking about them. If this kind of analysis is valuable to you, make sure you're following the channel. The next few months could be crucial for bond markets and the broader economy, and we'll be here breaking it all down. The endgame isn't here yet, but the signals are flashing, and now you know what they mean.